Good morning. This is Howie, and I'm here to help you win with money. For today's episode, we're going to start off with today's date Tuesday, October 27th. And market look like it's going to open up after yesterday's sell off. I mean, it was 2%, so it was pretty bad. And depending on what underlines you were holding and what stock you were holding, it was pretty bad for some securities. In this episode, we're going to look at energy. What's going on here? Down 200 points. Should you buy energy? Well, before I drag this any further out, this is only because of a 4-to-1 stock split. So some of the numbers look strange. You see, yesterday was $300 a share, but everything gets adjusted and it will be fine. So let's see if this works. I want to compare it to another energy company. Oh, the numbers will be okay. Let's do a comparison still. So let's plug in America's big energy company. We'll put that into a red because definitely it was looking like a red. There you go. It didn't do much. Let's Let me show you what it did in the short term. In about a year's time, you see this? NEE was up, Exxon was down. Let's zoom out for about a year. There you go. You can see the chart. We'll keep on zooming out and you're going to see something. And look at this. If you bought this about a decade ago, you can see NEE has done really well. Up 400%. ExxonMobil really hasn't done much. And that's kind of sad. And I'm going to keep on zooming out if this lets me. Oh, it stops. Okay. Anyway, why I'm showing you this. Should you buy energy? Energy has been really a dud of an industry, maybe even the last 6, 7 years. Now, was it always a dud? No. I own ExxonMobil. I collected plenty of dividends. My average cost basis was maybe under 40 or 50. I don't remember anymore. It was pretty low. And I collected a lot of dividends over the years from 2000 and onwards. And I collected dividends. And I made money in Exxon. And I sold it at $91, I think, on its way. Exxon eventually hit 100 and hang on, we'll back up and I'll show you. Exxon eventually hit $100 a couple years ago. I missed the peak. I sold it near the top though. If you can zoom out, this doesn't even show it. Look, $91. I may have to go into the full screen for you to see that. And let's just zoom out a little bit. What was that? $100. You see, and I missed that. I sold it at 91. I bought it back somewhere down here at 70 something. Sold it again at 80 something. But lately, you see this trend? So I sold. I didn't sell it all, but I sold more than half of my position, and I actually bought NEE, and I got into NEE at a really good price. Remember, I got in, maybe my first time I bought it was around 220 or so, and then it dipped down to like 180 or so, and then I think I picked up some other shares there. So why am I talking about energy? So let's go over why you should buy energy. Here's a article from the Motley Fool, and appropriately titled "Why Low Risk Stocks Can Bring You High Rewards." And we all know energy is in a utility sector, right? All of us pay for our water bills. Some of us have trash bills where waste management or whoever the other competitor is. Some of us have to pay, well, all of us pay electric bills. And so utilities are really a great business to own. But most people call them low risk, right? They're boring. They're not going to have 100% growth. They're not going to grow like your Amazons. So why own them? And this article covers some of the basics, right? You're not going to buy these high risk stuff like Virgin Galactic. And it goes into this whole concept of, yes, if you own it, because well run companies over time can still outperform the S&P. And you see that here. S&P over here on this time frame is this orange line. And look at this. They picked out American Waterworks, Waste Management, right, the trash company, and NEE. right? NextEra Energy. And you see this, they outperform the markets. And you would think this is crazy. How can a company that collects your waste, collects the trash, and process trash outperform the market? Because the market has a lot of good companies in here, right? It's all your FANG stock plus whatever, right? 495 other companies in here. And so the other thing I want to show you, another great article, right? 5 great stocks you can buy and hold forever. Well, what type of companies are in here? Look, something stable, railroads. Something stable again. Look, it happens that American Waterworks shows up here. And look at this, a play on future of energy. So again, clean energy. And it gets into all the details of why you should own it, dividend growth, and all that good stuff. Visa happens to be on here, and then Johnson & Johnson. And in this next one, here's, again, another writer. This is Seeking Alpha, and talks about why you should invest in it. And that's what we're going to talk about today. Real quickly, why you should own energy. This is a quick summary from their presentation, September 2020 investors event. Quick overview. You can read that real quick. You can pause it if you need to. They are expanding again in their renewable energies, wind, solar. Here's a nice look at long-term track records. Again, compounding annual growth rate. It's not bad, right? We're not looking at an Amazon growth rate or Microsoft or Netflix. But energies, people buy utilities for the dividend and the stable growth. And you see this, dividend, it's also growing really nicely. And then you can see the chart here, how it compares over 10 year. No matter which one you look at, 1 year, 3, 5, and 10. NEE has outperformed the utility and outperformed the S&P. I like this slide. Here's what they want to do, right? They're going to keep on growing and expanding clean energy. This is not a play on who will become president. This is a play on ESG investing. It's becoming more popular nowadays. If you don't know, Google it, get in it early. This is stuff that will drive future business. Other investors will come in, add this to their portfolio. There's going to be a lot more people like me who sell off their Chevron shares and their Exxon shares and move into something like this. In this slide, they're expanding. They bought up another acquisition here, and it adds energy up in this panhandle area. And here, I like this. Again, it talks about the adjusted EPS for the 4-for-1 stock split. Again, happened yesterday. I like this, right? They're projecting growth, right? Most investors are very, I don't want to say short-sighted, but we're looking at the next 2 or 3 years. And you can see, we want to see growth each year. Because what that means is, my share price will eventually move up at the same rate their business is growing. Sometimes your share price move ahead of the growth. And some companies, the share price moves behind the actual growth. But regardless of what it's doing, we want a company that keeps on growing for the next 10, 20 years. And back to my original question of why do you want to own energy? If you're a new investor, sometimes it's actually safer to start with blue chips or safe companies that are growing. Because if you're new to investing, the first thing you're afraid of is losing money. You're not going to invest if your first investment gives you a negative experience. And if you lose money right away, you bought a company like Enron and it goes to zero, you'll probably never want to invest ever again. And so I started off with very safe conservative companies. I picked Pfizer, I had ExxonMobil, I actually did buy an energy company as my first investment. And that investment has done really well. I think I'm up 300 or 400% on that one too. And it's an energy company that pays a 4% yield, which is really good. And at this age, I'm pretty happy with a 4% yield. If my money makes 3 or 4% a year from here on out, even if the share price barely moves, I think I would be happy with that. Now, the energy company I picked is still growing, and I picked it 20 years ago. So this is something that a lot of people can add into their core portfolio. In this slide, I love how they do this. They're using filters with the S&P 500, and as you add a new filter, if you use a stock screening program, right, it filters the 500 companies, and they just add a new filter, and each time you can see that the adjusted ESP has to grow, annual total returns, right? I think this is the dividend per share earnings, and then look, and even the low beta, right? So they're saying, wow, only one company meet all these criteria. What a great way to market themselves. That brings me back to here. And in the end, if you are a traditional oil company investor, Chevron, Exxon, BP, you may not be too happy with energy investments right now. It's a hard industry. And if you are looking at renewable energies, you may have done better. If you're looking at consumer companies that sell electricity or water to the end user, right, like a Duke Energy or Southern, you would have done okay. And so this is what I want to get across. You can play the energy sector still with relative safety. And like I said, I'm not recommending this company. This is what I hold. I am not a financial advisor. I own this. I got in way cheaper than $300 a share, and I'm looking for another 20 years of growth. This is a Florida-based company. I want to keep an eye on it. I am very happy with my energy investment. Hope you enjoyed this video. If you like what you saw, don't forget to like and subscribe to this channel. My goal is to help each investor learn a little bit more, learn how to invest properly. I'm here to help you make $1 at a time. And the more people get this, the better people will be. And I hope you have a profitable trading day.